Bismillahirrahmanirrahim. Subject is financial statement analysis, and this is sixth online lecture. And today we will discuss profitability ratios. Today agenda for today lecture is we will define profitability ratios. Then we will discuss formulas for profitability ratios. Then we will move further to elaborate profitability ratios with the help of numerical question or illustrations. Then we will have a short or brief discussion that how to interpret and discuss profitability ratio. Moving further, what are profitability ratios? Profitability ratio are those financial ratio or financial calculations used by analysts and investors to evaluate the ability of the company to generate income relative to revenue, balance sheet assets, shareholder equity, and operating cost for a specific time periods. It means that if we are going to discuss the profitability ratio for 2019, what we will do, we will have to measure or evaluate the ability of the company, that how much it earns or generate profit relative to the company's revenue, or relative to the company's balance sheet, or earning, whether it's earning in proportion with the shareholder equity, earning in proportion with the long-term debt. So we will discuss these financial ratios here. Higher ratios or higher value of the ratios commonly sought after by most companies, is this usually means that the business is performing well by generating revenue, profit, and cash flows. So higher ratios of profitability ratio is favorable because it shows that the company generating higher revenue, generating profit, generating cash flows. Why we are calculating these ratios? It is useful when analyzed in comparison to similar companies, or when we compare it with the previous periods, or we compare it with the industry averages, with overall industry averages. So is lonely or single ratio of any single companies is not helpful in making any opinion about the financial health of the company. So when it is used in comparison with other similar companies, or in comparison with the previous periods of the same company, or in comparison with the industry averages, then any analyst or investor come to any conclusive positions. Profitability ratio are broadly classified in two categories. One is margin, that is solely calculated from income statement figures, and other is returns ratios, which is calculated from income statement and balance sheet figures. We will use both income statement and balance sheet in return ratios. Margin ratios, example of the margin ratio that we will discuss in this lecture are gross profit margin, operating profit margin, net profit margin, cash flow margin, EBIT margins, EBITDA, earning before interest, taxes, depreciation, and amortization margins. We will discuss it in these ratios in this lecture. Then moving further, return ratios is a second category, that is return on assets, return on equity, cash return on assets, return on invested capital, which is also called return on capital employed, ROCE ratio. This is one and same thing, not and. It is used interchangeably. Return on invested capital or return on capital employed. Capital employed means both capital employed by shareholder and plus capital employed by debt providers. Now we will first discuss margin ratio. First ratio in margin ratios is gross profit ratios. Gross profit is calculated by deducting cost of goods sold from the sale. Sale minus CGS becomes what? GP, gross profit. It shows, this ratio shows that compares gross profit to the sale revenue. This shows that how much business is earning, taking account the needed cost to produce its goods and services. Means this ratio basically provides an information about that how much the company is earning after deducting or after taking account for the manufacturing expenses. Gross profit margin ratio is calculated by cost of gross profit divided by net sales. This is gross profit margin ratios calculation formula. Now GP is gross profit is calculated that sales minus cost of goods sold. Higher gross profit margin shows that reflect higher efficiency of the core operation of the business, meaning manufacturing efficiency, meaning that it can still covering operating expenses, fixed cost, dividend and depreciation. After gross profit, what left for is to cover operating expenses, to cover fixed cost expenses, to cover dividend, to cover depreciation of non-manufacturing facilities, and also provide net earning to the business. Low gross profit and return indicate that high cost of goods sold means the company is not efficient in preparing the goods produced by it, which can be attributed to adverse purchasing policy. Maybe the company purchases raw material on higher prices than their competitors. Their purchasing policies are not enough efficient to reduce its cost of goods sold. Lower selling prices is maybe one of the reason of lower gross profit. Maybe the company is in very much competitive positions, in highly competitive industry and cannot increase its selling price, or it is unable to increase its sale price. Or maybe low sales, stiff market competitions, or wrong sales promotion policies. These are some factors that can be keep in mind when your gross profit margin is low. EBITDA margin. First we will discuss what is this terms. It's E for earning, B for before, I for interest, T for this is a bit this T is not here, it is after D. This is for taxation, this is for depreciation, this is for amortizations. So earning before interest, taxes, depreciation and amortizations. This is why this ratio is calculated, why this margin is needed, because different company apply different depreciation method, different amortization method, different accounting policies for calculating amortization, different discretionary accruals. So in order to address the accounting engine earning management, in order to address the issues in accounting policies, we calculate this EBITDA margins. It stands for earning before interest, taxes, depreciations and amortizations. It represents the profitability of the company before taking into account non-operating items like interest, taxes, as well as non-cash items like depreciation and amortization. So these are some items which are already incurred costs, these non-cash item, and these are the item interest and taxes which do not come in operations. So EBITDA margin is earning before interest, depreciation, taxes and amortization divided by net sales. What are the benefits of this? What are the benefit of this ratio? Analyzing the company earning before interest, taxes and depreciation and amortization margin is that it is easy to compare it to other companies. It excludes expenses that may be volatile or somewhat discretionary. As I discussed earlier, that it reduces those problems, or it eradicate those problems that occurred in a company due to its accounting policies. So this margin is comparable with other companies. Even this ratio is used in valuation method in in different financial modeling. Operating profit margin. Operating profit is the profit that is calculated after when gross profit is reduced by operating expenses. So its earning is a percentage of the sale before interest, expense and income taxes. Earning before interest and taxes to sales ratio is called operating profit ratios. When the company have high operating profit margins, are generally more well equipped to pay fixed cost, interest on obligation, and have better chances to survive an economic slowdown, and are more capable of offering lower prices than their competitors that have lower profit margins. So the company having high operating profit margin, it can easily pay its fixed cost, it can easily pay its interest on obligation, it is in better position to combat with economic slowdowns, and more capable to offer even lower prices than their competitors. So operating profit margin is equal to earning before interest and tax divided by net sales. So operating profit margin is frequently used to assess the strength of the company's management, since good management can substantially improve profitability of the company by managing its operating cost. Net profit margin. Net profit margin, it's at the company's net income divided by its total revenue or net sales. It provides the final picture of how profitable the company is after all expenses, including interest, taxes have been taken into account. So it shows the company position when we deducted all expenses and what is left for shareholders. So net profit margin shows that picture of the company. Net profit can be calculated by dividing net profit by net sales. A reason to use net profit margin is to measure the profitability. It takes everything into account. This is what left for the common shareholders. What is the drawbacks in this financial calculations? It includes a lot of noise. Noise means those things which may be one time in this year. For example, if the company sell any of its fixed asset and earn profit from this sale of disposal of fixed asset, it will also be included. So this is one time activity, not recurring. If the company discontinued its operation during this 2019 and earn some profit from this discontinuing the operations, so this is one time activity, it will also be included in this net profit margins. So such as one time expenses or one time gains which are also included in this net profit, this is one of the drawback which make it harder to compare company performance with its competitors, because competitors may not confront such type of one-time activity. So this is one of the drawbacks in comparing net profit margin of the company with other companies. Cash flow margin, for this ratios we have to have cash flow statement. It is calculated by cash flow from operating activities in comparison with the sale generated by the business. So cash flow margin can be derived or can be gained from dividing cash flow from operating activities by net sales. The higher the percentage of cash flow margin, the more cash available to sales, to pay for suppliers, to pay dividend, to pay utility bills, to serve their debt, as well as purchase capital assets. Now, what if this cash flow margin is negative? It means that even the business is generating sales and earning profit, but again, if it is negative, it may still be losing money. In such cases, the company with inadequate cash flow will arrange some external financing or opt to borrow fund or raise money through investors in order to continue smooth operation of the company. So this is second category started, return ratios. Return ratios means return on assets, return on equity, return on capital employed. We will discuss these ratios. Return on asset name suggests shows that the percentage of net earning relative to the company total assets. Return on asset is calculated by dividing net income by total assets. Return on asset ratio specifically shows that how much after tax profit company generate for every $1 of asset it holds. It means that if net income is, let's suppose this ratio is 0.5, 0.05, let's suppose say, it shows that for each rupee, 1 rupee invested in the assets, it generate 5 paisa on this total 1 rupees investment. Lower profit per dollar of asset, the more asset intensive company is to be considered. If the return on asset is low, we can conclude that it is more asset sensitive or most asset incentive companies. Examples of the asset intensive company are typically include telecommunication companies, services, car manufacturers, cement industries, railroad, etc. Example of less asset intensive companies are advertising agencies or software companies. So asset intensive company always have low return on assets. Return on equity. What is return on equity? Return on equity expresses the percentage of net income to stockholders' equity, or the rate of return on the money that equity investors have to put in the businesses. So ROE ratio is one of its particular watched by stock analysts and investors, that how much this company is earning for shareholders. This ratio shows that how much the company or the firms earning for the common shareholders. So return on equity is equal to net income divided by shareholders' equity. High return income shows that investor will purchase the company stock. It gives green signal to the investors to buy the company stocks. If there is high return on equity, it is inferred that it generates cash internally. It is less dependent on the debt financing, so it is a bit less risky company. Return on capital employed. Capital employed, as I discussed earlier, that it means capital provided by shareholder and capital provided by the debt holder. So return on capital means that net income in relative to this two category of capital is called return on capital employed. So it is measures of the return generated by all providers of the capital, including bondholder, shareholder, or any other debt providers. It is similar to ROE but more in all-encompasses in its scope, since it includes return generated from capital supplied by bondholder or any debt holder. Debt holders. Return on capital employed can be gained by EBIT divided by shareholder equity plus long-term debt. EBIT is used because it represents the income generated before interest expenses. Why we are using EBIT instead of net income? Because earning before interest and taxes, it means this earning is available to both of these parties. So because it represents net income generated before subtracting interest expenses, and therefore represent earning that is available to all investors, not just to the shareholder. That's why we are using earning before interest and tax in these issues. Now we will explain this with the help of this illustration. We will use the same company as I used in earlier lecture, that is Quartz Cement Company Limited. This is share holder capital. This is issued subscribed capital, reserves, accumulated profit. So this is shareholder equity. We will use this figure. This is long-term liabilities, different kind of liabilities, and this we will use also this figure in calculating in these type of in these profitability ratios. This portion is ignored. This is non-current assets. We will use only this total figure in our calculation, not any individual figures. We will use only this total figure in profitability ratio. This we will focus on this net sale and this profitability ratio, cost of goods sold. Keep in mind that we will calculate ratios for this 2000 for the year 2010. So we will use sales, we will use cost of goods sold, we will use gross profit, we will use operating profit, which is also called EBIT. This is profit before income, interest and tax, means it includes other income and other profit as well. This is net operating income. This is finance cost, interest expenses. This is some losses because of loss on derivative financial instrument, which is not here. So when we pay finance cost, we will result in negative profit. After taxation, we get this negative profit. So we will use all these figures in calculating our profitability ratio. Now, while keeping in mind the balance sheet and income statement of the KCCL, you are required to calculate below ratios: gross profit margin, earning before interest, taxes, depreciation and amortization margin, operating profit margin, cash flow margin, net profit margin, return on asset, return on equity, return on capital employed. But we are unable to calculate this ratio because we don't have cash flow statement. So gross profit margin is, we discussed earlier, that it is equal to gross profit margin, gross profit divided by net sale, not margin. This is typo again. Gross profit divided by net sale. Plugging values in above formula from the balance sheet of Quartz Cement Company Limited for the year 2010. KCCL balance sheet, KCCL income statement for 2010, we get this is gross profit, this is sale, this is gross profit margin. It means that after deducting manufacturing expenses, only 9.484% is left for other expenses. Just for example, paying fixed costs, paying operating expenses, paying interest expense, paying dividend. So only 9% of the total sale is left for the other expenses. Earning before interest, taxes, depreciation and amortization margin is equal to earning before interest, taxes and depreciation and amortization divided by net sale. How it is calculated? When we have earning before interest and taxes in the income statement we will add back all depreciation, non-cash item, depreciation, expenses. In it we will get this figure. So I did it in Excel sheet, but it is not available right now. Divided by net sales. So earning before interest, taxes, depreciation and amortization margin is equal to this figure, which is calculated by adding depreciation expenses to earning before taxes divided by net sales. Net sale is available in the balance sheet of KCCL for year 2010. We get 7.98%. It means the ratio addresses the discretionary accruals issues and accounting policies variation among different firms. So it is highly comparable ratios. It shows that this is available in order to pay interest, taxes, depreciation, expenses, not operating expenses. Operating expenses cover in this one. Operating profit margin. Operating profit margin is equal to earning before interest and taxes divided by net sales. By plugging the value in above formula from the income statement of the Quad Cement Company Limited, we get Quad Cement Company Limited operating profit margin, that is available figure in the balance sheet, earning before interest and tax, profit before interest and tax divided by sales. We get 6.98%. This shows that only in 100 rupees sale, only 6.98% are left for paying interest, taxes and dividend to the shareholders. Net profit margin. Net profit margin is equal to net income divided by net sales. Plugging values in the above formula from the Quad Cement Company Limited income statement for 2010, we get below figure. Since net income is negative, divided by sales, we will get negative return. So the company generate negative return for the shareholders because this net income is only available to the shareholder. All other expenses are covered. Then what is left, it is called net income, that is only available to the shareholder, which is negative. Return on asset. This is second category start. Return on asset is equal to net income divided by total assets. Plugging value in the above formula, we will get this value from income statement, this value from balance sheet. For KCCL, return on asset is equal to minus, this is net income, which is negative, divided by total assets, which gave us minus 3.779%. It means that during 2010 the company generate 3.7% negative return on the total investment in the assets. Return on equity. Return on equity is equal to net income divided by shareholder equity. We will get the value for the above formula from the balance sheet and income statement of the KCCL company. We get below values, that is negative value of the net income. These values come from shareholder equity. This is extracted from the balance sheet and shareholder equity portion. This is net income extracted from the income statement of the company. So which show us that it generate negative 16% for the common shareholder investment. Return on capital employed, ROCE, is equal to earning before interest and tax that is available to both parties, shareholder equity in long-term debt. Plugging the value, we get ROCE, that is earning before interest and tax, which is positive, divided by, now let me explain. This value is extracted from income statement, earning before interest and tax. This is shareholder equity portion of the balance sheet. This is non-current liabilities, means long-term debt holders portion of the balance sheet. So it generates 4.7% positive return for both the parties. Generate for both long-term and debt providers and shareholders. This is all about today's lecture. Thank you.